Welcome to the August Spotlight on Insurance and Property Casualty Coverage, brought to you by ProducersWeb.com. I'm Paul Wilson, and in this broadcast we'll cover some of this topic's biggest trends and most insightful research. This Spotlight on Insurance and P&C is sponsored by Dressander & Associates. We dedicate ourselves to your success. For more information, please visit www.dressander.com. Fitch Ratings says that asset exposures and the capital impact of investment losses have contributed to recent negative ratings actions against insurers. According to the ratings agency, investment-related risk in 2008 became a primary concern for P&C insurers during 2008, as the recession led to unfavorable asset performance. However, P&C insurers were less affected by recent events than others in the financial services industry because of lower asset leverage and less exposure to mortgage-backed securities and other derivative instruments. In a recent report, Fitch also noted that the P&C industry's 2008 investment performance was largely unfavorable relative to long-term historical results, and found that firms that suffered the most significant investment losses held positions in common equities that were higher than average, or else were multi-line insurers that had asset allocations more typical of life insurers. The Harris Poll recently conducted their annual poll in which they ask Americans for their opinion on the 20 leading industries and their success in serving customers. According to the latest poll, industries faring especially poorly include car manufacturers, which fell 31% year over year, banks, down 24 points, and investment and brokerage firms, which declined 27 points. Meanwhile, health insurance companies declined 10 points, while pharmaceutical companies decreased 6 points. Hospitals rose 6 points, and life insurers improved 12%. Those viewed as most successful in customer services included supermarkets, hospitals, online search engines, packaged food companies, and computer companies. Finally, industries which were viewed as doing a bad job included tobacco companies at 63%, oil companies at 60%, health insurance at 58%, and managed care at 54%. Although asset managers expect it will take between 4 and 7 years to fully recover assets under management that were lost during the recession, a new report shows that insurers are ahead of the curve. The study by McKinsey & Company found that profitability will continue to diminish, and firms will be required to reduce expenses by as much as 25% to 40%, more than double the cost reductions that most asset management firms budgeted for 2009. In addition, according to David Hunt, a senior partner at the company, many companies became overly confident after average assets fared well last year before plummeting during the fourth quarter. He predicts that profits will be off by as much as 1/3 or 1/2 in 2009. Despite the pessimistic outlook, insurers could fare better. The study finds that despite insurers having held 20% of the nearly $11 trillion asset share in 1998, compared with 13% last year, there has been a shift in success by more pure-play asset managers, or those not owned by another financial institution. In 1998, such firms made up just over 1/3 of the market, but by 2000, their share has risen to nearly 2/3 of assets. I'm Paul Wilson, and thanks for watching the Spotlight on Insurance P&C. To see more video spotlights on your favorite products and practices, find them on ProducersWeb.com and browse by topic.